I'm Samir Shah. Just a intro, I was trained as a quant, ended up in mortgage-backed securities research. I've been doing fixed income research and economic research and so on for a long time, but I tend to study everything very deeply and focus on the entire ecosystem of finance and economics. So I know a little bit about VC as well. I have relatives in the VC space, et cetera. And so hopefully I can ask some intelligent questions. But I assume the panel will ask more intelligent questions than me, not the panel, but the audience. So just to introduce, we have 3 of our 4 panelists here. The 4th one is on a call. He's here, but he'll wander in as soon as he's done. So Ben Novak is an angel investor, and he's also works at Morgan Lewis as in a variety of functions focusing on emerging clients, equity financings, debt financings, corporate governance, also represents angel investors, private equity firms, and VC firms. As he represents Morgan Lewis, I'd like to thank him and the firm for hosting us.
Absolutely, happy to welcome you here. I hope you're enjoying the beautiful views from our bunker.
There's a lot of backlighting, so I actually requested that be closed.
Can you guys hear me now? Hey, all right.
All right, so Eveline Gerck is a financier, board member. She has deep expertise in investments, capital raising, relationship management on boards and so on. Before that, she was an institution. Before got involved in the private capital side. She was an II-ranked public securities analyst and has led over 40 billion in deals, including IPOs, M&Ms, growth equity. She's been specializing in global alternative investments, and she's on multiple boards. She's part of the K funds now and represents the K Fund 3, which does private direct investing in early to late stage US-based pre-IPO companies. Mauro is up on the screen. He's in Switzerland. This is a very well-rounded individual. He directs the Swiss Innovation Hub and partners with family offices. He consults with the Swiss government. He's done advisory work for the European Commission. He's been on the jury member for European Innovation Council. He is the founder of Eurodax and AFS, which are in the fintech crypto space. And he's also a quant teacher teaching finance and risk management as an adjunct professor at various universities. He also has an advisory business for all of this stuff, corporate finance risk, quant modeling, trading, et cetera. So and Gaurav, who is not here, is the founder of Mission One Investments. He's invested capital globally. So in his earlier career, he worked at public pensions. He worked at Bloomberg Philanthropies. He's worked at a lot of these large institutions and is very well regarded in that space. Now he's doing Mission One Investments and also has a OCIO business at Highland Consulting Associates. As part of Mission One and also at a prior family office, he led to the creation of 2 fintechs in India. So he represents our global investing panel member also. So I'll kick it off with some questions. So Eveline, you're advisor to many funds, investor, board member. You made the transition from public securities analyst to a private and global alternative investments. So can you discuss your career path, your genesis of your transition, how you ended up in VC and alts, how these products can fit into a portfolio for family offices, and what the ratios between maybe public and private securities should be?
Sure. Here you go. All right. So I moved from public equities into private equity when Wall Street changed the rules for analysts. We used to make money on the deals and also on recommending investments to, retail and institutional investors. And most of the compensation at that time was from deals that were originated with the companies that we followed. And then they changed the rules and said analysts would not get any bonus out of like merger and acquisitions and IPOs and so on. You only get money from the trading. So me and a lot of investors, analysts at the time, that's when I moved to private equity. So I worked with private equity for 25 years with Trust Company of the West as a principal, and also in capital formation because I had the expertise of like selling stories to investors. So and I still have that today. So that's one of the, when we talk about capital formation, with all the funds that I work now in venture capital, I always assist them in that area as well. So to move to private equity, I was, very fortunate because at TCW had a board of advisors and operating board. And that's when I learned value creation, which was very different from just analyzing companies. So then I was very well-rounded at the end of the day. That's why I'm on the boards now, because I had the experience in analyzing and also going through the life cycle of those investments, make improvements in those companies, and then exiting. So today I work with the K Funds, which is a later stage venture capital fund that invests primarily, fund 1 and 2, we had fintech, we had companies like SpaceX, like Chewy, like Epic Games. And now the second fund, we start going more into space. And now the third fund, we're going to be focusing on AI, healthcare with AI. Everybody, the AI is the word of the day. And we're still looking for investments in the space segment, which is hard to find another SpaceX. So who knows, we're going to have ever another one like that. I'm also on the board of a seed stage fund called Studio VC, and that's really, really seed. So the checks are like $100,000, $300,000. Very different from a later stage VC. And I'm also on the board of a hedge fund that does public equities. So to make a long story short, I have been working with family offices since private equity because we had Trust Company of the West as our sponsor, but we raised capital at the beginning as emerging managers with CalPERS and CalSTRS and so on. But to make the $550 million 3-time funds, we had almost $2 billion under management. At that time, we went to very large owners or corporations that we call today family offices. So I would say it was one of the first time of really building that family office space. My team left TCW, went to another company we formed just to manage the capital for 5 family offices. And then lately I was also on the board of Alpha Square, which is another family office. So to make a long story short, we have different types of family offices. We have the family offices, which are really large, like from the Chanel owners, from Schlumberger, from you name it. Those are very well, those are investment firms. They're not even family offices anymore. So they really have analysts and investment analysts. They look into investing directly in companies, but they also invest in funds. They have a better structure to really make direct investments. Then you have the smaller family offices, like some, in the West and the oil companies, families, owners in Texas and so on, and some tech entrepreneurs. So they're a little more sophisticated in the sense that they would make direct investments only in what they understand. And then they refer to funds like the K funds and other funds in what they don't understand to make investments in this space. And then you have the very small, investors that they have $1 million, $5 million, they call themselves family offices. And those are like trying to be a venture capital fund. Sometimes I see they're trying to make angel investments themselves and have a portfolio. And those are not the investors that we reach out to invest in our funds. So those are the categories I would say we have today, family offices.
Space investments, say energy
No, we don't invest in energy. In space, we like, well, SpaceX was a very good investment for us. So we see that other companies, there are with different technologies. But we have had introduction to companies that do, you have a lot of companies that started the space segment, like, now look at you, Mark, but that's one of them, right? And we'll talk about a deal we look together. That's, you know, companies that want to clean up space because you have trashing space, companies that work with the government and develop technologies for NASA, like when they go to Mars or when they want to have a colony in the moon, on the moon or something like that. So we like to invest in companies that will become, you know, self-sufficient very quickly and EBITDA driven very quickly. And SpaceX was an example of that. So it's very hard to find another space company in the space that would have this type of growth acceleration. And we're looking. So if you have anything, just show me. But we haven't found, we're just looking, but we haven't found another SpaceX yet.
So I have a question. Yesterday, we had a panelist who discussed defense. And so obviously, there's a big intersection between defense and space. Now, I suspect that there's a component of investors that will not invest in defense for whatever, you know, social reason. But they may be interested in space. Does this create a conflict in your investor base?
Well, the concept of the K funds is to invest in companies that make lives better and easier. Yeah. So we believe that SpaceX does that through Starlink, for instance. So the investment in space and companies that were in the defense space, and I know a lot of companies, you have a lot of companies in DC and also in Massachusetts that develop technology for NASA and for the government. This is a very different area than the space technology of, like, for instance, if you have a company that didn't work out, which is the Virgin Atlantic owner, Virgin Galactic, that would be a company that would be sending tourists to space. That would be an interesting company when ran out of money and didn't make it. So I think that you're going to have other ideas how to develop tourism in space, how to work with companies that work for the government. Because at the end of the day, SpaceX is working with governments as well, right? So it has an interlink and is complicated because you don't have like a map of space, who owns what, who owns the moon. So this is really like the developing, not only technology, but a developing concept. And we are following that and see where the opportunity is.
Okay, so just following that same, you know, connection thing, how about downstream into materials? Like, would you invest in a titanium manufacturer?
No, the K funds only invest in technologies. They wouldn't go like into manufacturing.
Even though that these things would facilitate space.
No.
Okay.
Because this would, you know, when you go into manufacturing, I did invest in manufacturing before, you have a whole, when you analyze a company like that and help a company like that is very different from a, let's say, consumer-driven or technology-driven company. You have like supply chain issues, you have the material issues, you have constraints of value of different metals, and the K fund just doesn't have, we don't have this type of, I mean, I do a little bit, but the fund itself is not the area of expertise. The area of expertise is really finding those technology companies that make lives better and easier, and that the EBITDA growth accelerates very quickly. So we usually invest like 3 years before the company grows like exponentially, and SpaceX never going to be IPO, I believe. Nobody does, but we have a lot of exits for secondaries, or if the company IPO. So that's the strategy, the investment strategy of the K fund is, you know, find that winning horse that in 3 years is going to win the race and value a lot. So, and we don't have expertise in metals and manufacturing. That's not what the K fund does.
All right, thank you. So Ben, you're the angel investing expert here. Can you discuss, Ben runs an angel investing group also. Can you discuss your angel group, what they're looking for? And also, how does this relate to your work at Morgan Lewis, the size of your team over here, the kind of stuff they do as well?
Sure, absolutely, Samir. Happy to go into all of that. But first, let me just say that, I've been a participant in the audience today and really enjoyed, listening to the earlier panels. And I particularly like it when panelists disagree and the audience disagrees. So I would welcome you all to disagree with what we're saying here. I know you all have unique perspectives. So to, I guess, take it from the top. So I'm a partner here at Morgan Lewis in our corporate and business transactions group. I practice specifically in a sub-area group that we affectionately refer to as the ECVC group, so the Emerging Company and Venture Capital Practice. In plain English, I basically work with startup companies and investors in startup companies. It's a stage agnostic practice, so I work with companies that are pre-product, pre-revenue, pre-everything. It certainly seems like I skew very early as compared to some of my fellow panelists here. But we also work with, large companies, public companies, startups that have hundreds of millions or billions of dollars in revenue. On the investor side, it's also relatively stage agnostic. So I work with individual angel investors that might be investing tens of thousands or hundreds of thousands into a pre-seed stage company. I represent traditional venture capital funds doing Series A's, B's, and C's. I do some private equity fund work, represent some family offices, some big banks, some sovereign wealth fund. So as you can see, it's $500,000 checks as well as $500 million checks through Morgan Lewis. So separate and apart from the full-time law practice here at Morgan, I'm also personally an active angel investor. So I've been deploying my own capital about 11 years now. I invest primarily in seed stage tech companies based on the East Coast. I look at about 1,000 deals a year, target investment in 5. So it's a pretty steep funnel. And if anybody's looking for deals, I have a lot of deals that cross my desk, especially early stage deals. And the group that you're referring to is kind of I'm a member of a couple of different investment groups, but my primary one is called DCIG, Delaware Crossing Investor Group. And so that's a mix of mostly mid-Atlantic based investors that invest in a tight geography. So we actually only invest in mid-Atlantic based companies, which we define as Boston to DC, Pittsburgh to the ocean. So we have a tight geographic focus, but we have a wide industry focus. If you look at our portfolio over the past 20 years, about half are in tech and about half are in life science, but we've done snowboard deals, beverage companies, sneaker companies. So it's a wide industry focus. Our sweet spot is that, and in terms of stage, I would call us seed investors. So we don't do too much pre-seed and we don't do too much post-seed for first check-in. So we'll participate. We're not one and done angels. We'll participate in A's, B's, and C's. But in terms of the first check-in, if you're already worth $100 million, you're too late for us. Most of the companies that we like to invest in, that I personally like to invest in, are single-digit million pre-money valuations. So kind of 3 to 9. We're looking for that 20 to 30x angelic return. We're willing to take the risk early, but we're looking for that upside. So to answer your question about Morgan Lewis and our practice here, so I'm one of about 14 partners that are core ECVC partners. My partner, Steve Cohen in the back, who chaired our group for the past few decades, is here. There's 14 of us that basically spend at Morgan Lewis 100% of our time doing this work. We have about 25 partners around us that also do this work a fair chunk of the time. So that 39, 40 partners is the core group. We have about 50 or so associates that also dedicate their time to this early stage work. So the core team here at Morgan Lewis that works with startups and investors and startups is about 90 attorneys. But we have hundreds of corporate attorneys around us and 1,000 plus other attorneys around them. So it's really kind of a one-stop shop. So as you can tell, I wear a couple of different hats. I'll quickly also mention, many of you may know the ACA, the Angel Capital Association. It's the world's largest association of angels. We currently have about 16,000 accredited investor members. We have membership of over 250 of the North American-based angel groups. I serve on the board of directors at ACA. I'm going into my 3rd year on the board there. I chair one of our committees, and an increasing amount of every day is taken up with my ACA activities. So happy to kind of talk with those different hats and address your questions. Happy to talk about early stage. Yep. Mhm. Absolutely. So through the Morgan Lewis hat, absolutely. Yeah. So we have a stage agnostic practice. Like it's not seriously uncommon for us to be doing a $500,000 deal and a $500 million deal in the same day. So the core of our group is kind of the traditional VC practice. So people investing, 8 million in a Series A and 40 in a B and 100 and something in a C. But I tend to skew a little bit earlier on our team, but I also do sovereign wealth fund deals that are regularly in the hundreds of millions of dollars. So we also represent some of the bigger banks, JP Morgan, Jefferies, Morgan Stanley. So those deals also tend to be a bit later stage.
Great, thank you. Mauro, can you hear me? Hello?
Yes, I can.
Oh, okay, great.
Yeah.
And we can hear you. So
You hear
that's
me?
good.
Okay.
Yeah.
Wonderful.
Actually, could you speak a little louder when you, or closer to the mic or something? It's still a little soft.
Well, I should
anyway.
be pretty close. Are you able to hear me or not? I maybe can change something here in the settings.
I don't know if this does anything. All right, well, let's try. So you've been heavily
Are you able
involved
to hear
with.
me better now?
Oh, that's better. Thank you. You've been heavily involved in many aspects of finance in many different European countries, and you've been teaching as well. Can you tell us a bit about your journey? Has academic research led to the creation of the financial activities, or is it the other way around? Are you focusing on teaching and sharing your experience and training the next generation? Or is it purely, building up the business?
Thank you very much for the invite. First, well, I will tell something about me. I've started my career in Citigroup in the investment banking department in London. Unfortunately, that was 2007 and probably not the best year to start a career in finance. Then I moved back to the university at Bocconi in Milan, where I started to work as a researcher at the Cres Center. I made also at that time some scientific publication in finance regarding the relationship between risk and return, and in particular about models like the capital asset pricing model. And I have to say that actually my studies brought me in building an innovative risk management model that was later acquired by some Italian airports. In that period, I was pursuing an academic career, and initially I was prepared to start a PhD in finance at Yale. However, as a consequence of the success of my risk management model, I received an offer from Ernst & Young and now EY, and weighted the costs and benefits. I decided to join them. I took the role of quantitative leader for the Mediterranean area, while maintaining my academic position. This balance allowed me to observe the burgeoning intersection of technology and finance, and particularly how new technologies were reshaping the financial services. The fusion of finance with technology, especially in areas like artificial intelligence, blockchain, and cryptos, has created significant opportunities and challenges. Artificial intelligence is enhancing decision-making and operational efficiency, while blockchain is revolutionizing transparency and security transactions. Crypto, though volatile, continues to evolve and integrates into the mainstream finance, as we have seen with ETF and the recent news. This blend of finance and technology, referred as fintech, has driven me to various roles, actually. Notably, I served as a consultant for the European Commission. I have been a jury member of the European Innovation Council inside probably what is the biggest program around the world for financing innovation. That is Horizon Europe, is a 95 billion program. And currently, I'm holding a similar role with the Swiss Federal Agency for Investment that is in Swiss. So I'm advising the Swiss government for investments in innovative companies through the government fund. I'm evaluating small, medium enterprises, and I consider myself to be very lucky because I have the opportunity to see some of the most revolutionary companies that will be the future unicorn in Europe and in Switzerland. In addition, I'm partnering with the two family offices here in Ticino, south of Switzerland, focusing on digital, financial, and blockchain topics. And I am following several startups. One of them it's the European Digital Asset Exchange, a platform that is tokenizing securities. So really deep into security tokens with the possibility and with an authorized secondary market based in Switzerland for security token. This combination of finance and technology not only drives my professional endeavors, but also I believe it will represent the future of financial services.
All right, thanks, Mauro. So we've the first block of questions got us up to the present. So let's try and look forward. Eveline, what future tech do you find most attractive? What do you think is AI seems to be hyped? Do you agree with that? What's fully priced? What's overpriced? What's still attractive? What do you hope comes down the pike? Which of these sectors improve our lives? What aspects of our lives need improving?
Yeah, so last year we had a very big correction in the early stage companies, really in the whole venture capital spectrum. So what is happening in venture capital, primarily the past 2 years, was really high to exit investments. Having said that, then you have a lot of investors that are not very happy because they want their money back. And that's the conundrum that fund manager has right now. Do I exit just to increase my DPI and I can raise another fund, but then I'm not going to exit high enough? So what is happening with most of the funds, and this is like the seed stage funds, the one that really being hit harder. And so for instance, Studio VC, what we are doing, we had companies that we invested when the valuation was like $30 million. And 2 years ago, the valuation was 1.5 billion. And that's an interesting thing when you're on the board of a fund and you talk with the fund managers and you say, look, it's good enough. And they say, no, this company is going to be worth $10 billion. The CEO told me that. And no matter how experienced you are and the board is, and you talk with the fund managers, if they don't want to exit, they don't. So we are exiting that 1.5 billion now at 700 million. And they think it's a great thing. So I think that the first lesson is in terms of primarily the earlier stage funds is you really need to have, like public markets, you should have a discipline. When is like my exit price? Unfortunately, in the tech world 2 years ago, nobody believed that you had a ceiling, that you had it's going to go forever. I don't know, everybody was on drugs or something.
What goes up must always go up,
Yeah,
right?
it's going to go up forever, and it's never going to, and was across the board.
Well, there's still the hope that the Fed will come in and, you know, juice it all up again.
So this was not only, you know, in the early stage, was in every stage of venture capital. On the other hand, you have private equity in a crisis because they couldn't do LBO because the interest rate is up the top. So they were like, you know, losing their shirts and say, okay, I'm going to do like real estate, private credit. They're going all over the place like to make up for the loss. And the investors are not seeing money back from either. The venture capital didn't want to exit because it's like it's going to go to the roof, and the private equity couldn't leave because they were in trouble. So because of that, that area of private investments, both venture capital and private equity, was not in a good place in the past 2 years. The other problem that investors had, most, primarily the very large investors, is that with the valuations, up there, when they look at their portfolio, the private equities, both venture capital and private equity, was really overweight in the portfolio. And they had to go to public equities to balance the portfolio. So to make a long story short, then the world changed and everything went down, and that's where we are. So where we are right now is the venture capital funds are having to sell not at the huge profit they could have done before. And the beauty of this whole process is that investors can now invest in venture capital funds again because now everything is cheap. But the funds that haven't returned enough capital are having a hard time raising the fourth, the fifth, the third fund because, like, where is my money? Having said that, here goes like the maturity, the other fund, the K funds, they were a little more pragmatic on that. So they did exit 2 years ago, and they held to companies that they thought that would, I'm going to hold much, much longer. So they were, I think the maturity of the discipline, like, enough is enough. That particular fund, the K funds, did well. The seed stage fund followed the market. So to make a long story short, I think that right now is a good time to invest in the funds. And I think a lot of family offices that try to make investments themselves are like licking their wounds, because if you haven't done direct investments in your life before and you think, I'm going to invest in anything and everything is going to go up, and you're not a professional investor, you're burned. So what I think is going to happen is like across the spectrum of the, even angel, well, not as big family offices, they will be looking into investing funds more than like 2 years ago. I don't want to invest in funds. I can do it myself. I know I can do it. And I think that they learned that, maybe you can try 1 or 2 companies, but if you really want to preserve your wealth, you should give it to the professionals. That's where I think we are right now.
I just wanted to make one comment. It's actually going to be a comment. I know K funds very well. And I think K funds.
Marty, louder.
You're going to have to repeat it.
Okay.
But K funds spun out of a family office.
Yeah, exactly.
But in Southern California, it's headed by a guy who's got tremendous background, and they are incredibly well networked in the space. So deals come to them. They get club deals that nobody up. Their first call in Southern California to get a deal done. Like, this one has it's got some hair on it. What's the price? How do we get it done? Blah blah. I've got SpaceX. We want some. Gotta just finish off this little piece. Are they the sponsor on many deals, or are they typically co-investor?
Marty, let me repeat the question. Yeah, so Marty said that K Funds is very well known, it's spun out of family office and is based in Southern California, and they get looks at all kinds of deals. Incredibly well networked, well ahead of other people. So the basic question was,
Are they typically a fund sponsor, or are they? I think they're more typically co-investor.
are they co-investors or fund
Yeah,
sponsors?
we're never
How do
the
they go
first
about it?
check. Now, we have 2 strategies. One is that we invest directly in the companies, but we also invest in funds. So those funds also,
Are they typically the deal sponsor or underwriter of the deal, or are they co-investors?
co-investors, yeah.
But they get great.
Yeah, and then we invest in the funds as well. So the funds bring us the deals. But for instance, we have, the other thing that we do is every company in the portfolio, we do a co-investment, like an SPV for the family offices. So they invest in the fund, and if they like SpaceX, we have the SPV. So now, for instance, we have one company, which is a healthcare company, that we are doing an SPV. And that's a company that you really have, as you said, is very, very hard access. So that's the tradition with that fund. It's like really get like very good deals at good price of companies that are going to accelerate very quickly and exit very quickly, and then also give the opportunity to investors to co-invest with us in those companies that are really hard to get in. So when we got into SpaceX, it was really, really at the beginning, and we invested, multiple times, and we had 3 SPVs on that. So now we're going to start exiting a little bit. So it's the same thing we're doing this healthcare company that we believe, and Fidelity, which is one of the big investors, believes is going to be like, not like this guy is saying that healthcare is going to be like Apple, but we believe that's going to be, big enough. That's an opportunity that we have because we're really close with the company and the first investor in the company. So we get those great deals and the great allocations. So that's another thing about the K funds.
So actually, you brought up the topic about venture not being able to free up capital. And I was going to bring this up later, but now we may as well drill into it a little deeper. So yesterday's Wall Street Journal had an article called, "Can Venture Capital Keep Itself Afloat?" And there's a little chart over here, which is the
Pay
ratio.
attention, it has the newspaper itself. That's a classic. That's a classic.
There's a chart here, the ratio of capital called to capital distributed for North American venture funds. And I don't know if you guys can see this, but this is the current ratio, which has gone vertical. It is higher than in 2003. And besides that, the rest of the period, it's been nice and easy to run and manage venture and keep rolling the capital. So what I've seen in the debt markets is people are starting to do venture debt. They're capitalizing on their gains, and rather than cashing out the equity, they're issuing debt against their portfolio gains to try and make distributions to partners and generate dividends. Private equity is also doing this. But what do you think of that whole business? I think it's sketchy. They should not be doing this. They should be writing it out. And they should have screened the investors to make sure that they have the ability to ride the storms, as opposed to taking in foundations that have to spend 5% of their assets, and now they're screwed. They have no distributions.
I'm going to delegate this question to you.
So the benefit of being an angel is I don't have a 10-year fund life to deal with. I can hold on to my portfolio, and of course, every CEO I meet with says they're selling in 5 to 7 years or 3 to 5 years, but I hear 10. So, I guess to your specific question about venture debt, you're probably better suited to address this one from a VC perspective, but it's lots of creative ways to make money. A lot of it, I think, comes down to the right strategy for your particular model, right? So my angel model coming in is very different than a Series A or a Series B model. I generally am looking for that equity upside. So pretty much all of the deals I invest in are preferred stock deals. Sometimes I'll do a convertible note if it's a more pre-seed stage company, but I'm basically looking to get that equity as quickly as possible and continue to exercise my pro rata or more in each subsequent round if the company's doing well, to kind of target that 20 or 30x return. But if you're a later stage venture fund and you're not going for the 30x, there's lots of different models and different deal structures to potentially address what you're trying to accomplish. But you have to have a coherent strategy for sure, right? So you can't be an early stage angel investor investing in seed stage companies looking for that 8% return. Doesn't work out.
No, I was thinking he was representing one of the venture debt. I thought he was representing one of the venture debt funds. So.
All right, Mauro.
A question or a comment in the back, Steve? You want to jump in?
Let's say you're expanding and the company IT or software company and you want to increase your sales force.
No, but that's leverage at the company level. This venture debt is coming at the sponsor level
Well,
to make distributions.
Yeah.
Sorry.
venture debt for sponsors. I've represented venture debt funds before this is going back. And they were at that time referring to private equity.
The venture debt itself.
And so normally what they would do is extend, they would invest early in the round and make it a 24-month or 36-month loan company. That would buy them about another 6 months in the market, get very nice return on capital, and then they'd also get warrants back in the company. So you already have backing by the warrants would eventually be invested. So it made a lot of sense to give them that extra runway because you never know what's going to happen. Right, you may have got feed rounds. Got a 36-month loan, which they expect to.
Yeah, historically, I think venture debt was about 30% of the feed round, and then there's a distortion clause by Silicon Valley Bank. It's kind of enabling
Silicon Valley Bank.
and what do they do?
They did lend debt to the collateral against that venture debt. You have to think of the millenniums.
I'm pretty sure nothing also.
Yeah, so I think we're talking about a couple of different things with the same term, right? So, through Morgan Lewis, we've negotiated several venture debt deals that I would consider either on the SVB side or companies that were raising capital from SVB or East West Bank and the banks that kind of play in that space. And like you said, they have a similar model where they're not coming in to a pre-seed or seed stage company, but maybe a Series A stage company that needs a couple $1 million to buy inventory. They have revenue. They're getting a secured debt position on the top. We do those deals. You're talking about some of the later stage venture debt that's similar but a little bit different. On the earliest stage, there's also a somewhat growing trend in what I would generally refer to as revenue-based financing. So instead of taking a SAFE or a note or an equity interest, it would be structured as a debt instrument that wouldn't convert like your typical convertible debt into the next priced round, but basically you'd be taking cash as the company grows. My quick thought on that from the investor's perspective is it comes entirely down to the terms. So if you're getting a nice chunk from a successful company and they have the ability to give you cash early on, you might get a great return. But if you're picking the wrong companies or you're not getting enough return quick enough, it's a tough model to sustain.
We have a question here.
I was in San Francisco for the last 15 years. Why do you feel that the technology space is a winner take all space? My brother raised last week in a meeting. OpenAI says, look, for 5 to 10 years, we're working on anything. It's not going to, but my brother's point is, look, for every one of you, there's 2 big guys that are neutral on it, and another 2 that are looking to. And yeah, I just.
So the question is, why is the tech field in the Bay Area so winner take all mentality?
So winner take all, I didn't understand exactly, what do you compare, the Bay Area to New York? I mean, you're saying that everybody wants to invest in tech in the Bay Area, that's what you're saying?
No. The point is like, okay, if you look at the unicorns, right, they tend to out-market cap by so far the second, right? And whereas like, even in finance, where you can say we have the Raiders in the 80s, right? RJR, all this stuff that happened here, like, it just seems like the tech is a little bit more maniacal, even to me, it's outside of your why is it self-select that is the problem? Why is it that way? It makes
I still don't understand the question. What he
So
wants to know
one of the things that we
specifically.
diligence in the earliest stage deals is basically, is this a winner take all market where there's going to be one leader that eats everybody else's lunch? Or is this a marketplace where there's going to be multiple winners, right? So especially, like if you're possibly playing in a smaller market, it might be a winner take all. In some of the larger markets, there's enough room for there to be multiple winners. Certainly when you're dealing with companies like OpenAI and others that have raised billions and billions of dollars, like it's a very different game. And sometimes you do have such a, sustainable competitive advantage because not too many people have access to that type of capital that you start to get far ahead and you start to kind of sustain that lead.
Now I understand the question.
Yeah,
Okay.
I also think
So-
that there's a migration to safety that's always been there. You don't get fired for investing in IBM. That was the thing in the 80s, right? And so it's I think allocators are in the business.
I mean, in
Yeah,
my
there's a-
model,
There's a distortion in the market right now, right? And if you look at the trend, especially in Silicon Valley companies, they go public, they become the acquirers. And so
Exactly,
Apple,
yeah.
Google, they average 10, 20 acquisitions a year. And nobody really realizes that each one of them has done 250 acquisitions in the last 10 to 15 years, right? And so they're just become the umbrella or the tent pole, and then everybody else gets acquired by them. So they'll never have the same valuation because then they become an acquisition target. They're never an IPO target. Returns are different, valuations are different. Got to go to the next panel.
Oh.
Thanks so much. Great job.
Great.